Hi guys, this is Hubert Madoro from William Milestone Forex Group. So today I'm going to talk about spread. What is a spread in Forex trading? How do you use it? So let me start by explaining in depth so that you have a better understanding. Forex brokers quote two different prices for currency pair, the bid and the ask price. So the bid is the price at which you can sell the base currency. When I say base currency, it's like when you want to trade two currencies, you always have base currency and quote currency. So the base currency is the first currency. The quote currency is the second currency. Example, GBP JPY. So GBP will be your base currency, JPY will be your quote currency. So the ask is the price at which you can buy the base currency. The difference between these two prices is known as the spread. So it means the gap between bid and ask is what we call spread. Spread is how no commission brokers make their money. Yeah, there are different types of brokers that we spoke about on the last lecture. So they are the brokers that doesn't take commissions from traders, and those that take commissions. So those that doesn't take commissions, they make money from spread. Instead of charging a separate fee for making a trade, the cost is built into the buy and sell price of the currency pair you want to trade. So when a broker claims zero commission or no commission, it's misleading because while there is no separate commission fee, you still pay a commission. It's just built into the spread. So what they will do is they will say, we don't take commission, but they will make sure you pay the spread. So in another way, they will make your spread bigger so that you pay the commission that you don't see because they don't claim to use commission. How is the spread in Forex trading measured? The spread is usually measured in pips, which is the smallest unit price movement of a currency. So whatever the price going either up or down, the distance that the price is moved, that's what you call a pip. For the most currency pair, 1 pip is equal to 0.0001. An example of 4 pips spread for Euro USD would be 1. Let's say price moved from 1.1051 to 1.1053. This code indicates a spread of 2 pips. What you do is, if you want to calculate, you subtract this one. Just after the comma, you subtract 0, that's 1053 minus 1051, and you get 2. So that's your distance. They what we call pips. This is another good example. As I was saying, base currency and counter, say that it's called counter currency or quote currency. So when you want to buy or you choose your pay, Euro USD, Euro become your base, USD will become your counter currency or your base currency. So the bid, normally when you open your MT4 platform or MT5, if you choose a pay, you will see this option. There is the first price, that is 1051, 1.1051, that's your bid price. Then 1.1053, that's your ask price. So the difference between 1053 and 1051, that's what we call pips. So if I subtract 1053 minus 1051, I get 2 pips. So the spread goes to 2 pips. Currency pairs involving the Japanese yen are quoted to only 2 decimal places. Unless they are fractional pips, then it's a 3 decimal place. For example, USD JPY, don't forget USD is your base currency, JPY is your quote currency, would be 10.00 and 10.004. So this quote indicates a spread of 4. If you subtract 0.04 and 00, you get 4 pips. What types of spreads are in Forex? The types of spreads that you see on a trading platform depends on the Forex broker and how they make money. So it's either they make money from spreads, it's either they make money from commissions. I told you how you see the difference or how you compare. I'll also show you, not today, what to consider when you want to choose a Forex broker. So there are 2 types of two types of spreads. Number 1, fixed spread. Number 2, known as variable or floating spread. So what happens to fixed spread is this. These type of brokers that uses fixed spread, if say that there is news that is coming or there is no news release, say that there is NFP or no NFP, the spread will remain the same. If they said this month our spread is 1.1, it will remain 1.1 for the rest of the month or for the rest of the year. So it means the difference between the ask and the bid is always the same. It's either we are going up, the market is going up, or the market is going down, or the market is going sideways, what we call consolidation. The size of the spread will still be the same. But now on variable, what happens is this. These type of brokers, those who use variable spreads, now what they do is they manipulate price. If they decide, let's make the spread, if there is no much movement, the spread will be 1.1. If there is news release, the spread will be 5. If they decide, okay, let's make it 3, let's make it 2. So it means the gap between ask and bid is not equal at any given time. In 5 minutes time, it will be 1. Maybe in the next 10 minutes, it's 5. So you should know these 2 types of spreads. That is the fixed, the one that doesn't change. The variable, the one that changes at any time. Fixed spreads are usually offered by brokers that operate as a market maker or dealing desk. Remember, I spoke about dealing desk and non-dealing desk. Model, while variable spreads are offered by brokers operating a non-dealing desk model. By now, you should know the difference between non-dealing desk and dealing desk brokers, because remember, on our last lecture, we spoke about this. If you didn't attend this lesson on types of brokers, check on our YouTube channel where it says what is dealing desk and non-dealing desk brokers. When I explained about brokers, actually the heading is called what is broker and the types of brokers that we have. Okay. What are fixed spreads in Forex? Fixed spreads stay the same regardless of what the market conditions are, as I was saying, at any given time. In other words, whether the market is volatile or either it's not moving that much, fixed spreads are offered by brokers that operate as a market maker or dealing desk brokers. Using a dealing desk, the broker buys large positions from their liquidity providers and offers these positions in smaller sizes to traders. This means that the broker acts as a counter party to their clients. These type of brokers I also spoke about, they trade against their clients. So you should also know what are the advantages of trading with fixed spreads. Fixed spreads have smaller capital requirements. Number 1, no trading. So trading with fixed spreads offer a cheaper alternative for traders who don't have a lot of money to start with. I want you to check the broker that I can recommend you. We don't do affiliation with the broker, but you just go and check, register on your own. I don't need to refer you. Just go to their website and check. I recommend them because I've been using that broker for years now, which I call it Traders Way. You don't need to ask me, hey, can I have a link to the broker? Just go to their website. Trading in fixed spreads also makes calculating transaction cost more predictable. Since spreads never change, you are always sure of what you can expect to pay when you open a trade. What are the disadvantages of trading with fixed spreads? Record can occur frequently when trading with fixed spreads, since price is coming from just one source, your broker. Let me explain what is recording. Okay, I will give you an example of recording. When I say recording, it's like, let's say you try to open your trade. There's sometimes where you try to open a trade on your MT4 platform, it's either on your phone, iPhone, Android, whatever, and the broker refuses to make your order process. Let's say you want to enter a buy. You will see where it says reject or accept, or it's like enter again. What they just do is they normally see where you guys want to place orders, or they normally see where your orders are. If they know or see that you guys, let's say millions of traders, want to enter this trade at a certain prices, they can just reject your orders, so that by the time they will accept your order, the price that you wanted to enter the trade at first, they've moved. So you won't make money from that price. So the moment your order is rejected, some of you say, okay, let me try in the next 2 hours, next 5 minutes. But the price is moving. And by frequently, we mean almost as frequent as Instagram post, blah, blah, blah. Don't focus on those. Okay, let me... Record message will appear on your trading platform, letting you know that price has moved and ask you whether or not you are willing to accept that price. It's almost always a price that is worse than the one you ordered. As I explained, slippage is another problem with brokers that use fixed spreads. When prices are moving fast, the broker is unstable, is unable to consistently maintain a fixed spread, and the price that you finally end up after entering a trade will be totally different than the intended entry price. Slippage is similar to when you swipe right on blah blah. Okay, don't focus on those. What are variable spreads on Forex? As the name suggests, variable spreads are always changing. With variable spreads, the difference between the bid and the ask prices of a current space are constantly changing. Variable spreads are offered by non-dealing desk brokers. Non-dealing desk brokers can get their pricing of current space from multiple liquidity providers and pass on these prices to the trader without the intervention of a dealing desk. This means they have no control of the spread, one, and spreads will widen or tighten based on the supply and demand of the currency and the overall market volatility. When I say volatility, market volatility, I mean when there is too much movement in the market. That's what we call market volatility. And for you to have an opportunity to enter, you need volatility in the market and know when to enter. Typically, spreads widen during economic data release, as well as other periods when liquidity in the market decreased, like during holidays and when the begins. It's like, let's say an example, if the president of the United States, Trump, want to say something, you should expect the US pairs to open up spreads and the volatility of those pairs. So, okay, normal spread, wide spread. So remember we said bid ask. So if you subtract 58 from 60, 58 from 60, you get 2 pips. So your spread will be 2 pips. If they change the spread from 48 to 68, sorry, from 60 to 68, if you subtract 48 from 68, you get 20 pips. So the example here is just telling you that variable spreads can change any given time, from 2 to 20, or even from 20 to 5. It depends with what example here. The Trump United States should be penalized because we are doing well, tightening now, blah, blah, blah. This is like a tweet from Trump. This can cause something in the market and cause the heavy manipulation, opening of spreads, gaps in the market. So you should know what type of broker are you using. What type of spreads do they use? What are the advantages of trading with variable spreads? Variable spreads eliminate experiencing records. So it means variable spreads, there is no too much recording like the fixed spreads. This is because the variation in the spread factors in changes of price due to the market condition, but just because you won't get recorded doesn't mean you won't experience slippage. A slippage is like when you enter a trade and it takes few minutes for your order to be placed. That's slippage. Some broker takes 5 seconds, some is instant, but there's a time, especially when there's news release that is coming. These guys, they will take advantage of you. Slippage, using slippage. Trading with variable spreads also provides more transparent pricing, especially when you consider that having access to the price from multiple liquidity providers usually means better pricing due to competition. What are the disadvantages of trading with variable spreads? Variable spreads are not ideal for scalpers. So now what you guys should do is you should know what type of trader are you. Are you a scalper? Are you an intraday trader? Are you a swing trader? Are you a position trader? So this will help you to know what type of broker that you need to use. Scalper is the one who opens a trade and expect to close that same trade in the next 5 to 10 minutes. Intraday is a guy who opens the trade, let's say in London session, then you expect to close that trade before the next day or before the US session closes. Swing trader is the one who open a position and expect to close the trade and hold it for 2 to 3 weeks or to a few months. Then position trader is the one who holds for months and years. Holding a trade for 2 years, yes, it's possible. Some of us, that's what we like, swing trading and position trading. Why? Because that's where there's more money. Because if you're using higher time frames, you don't make too much mistakes. Because at the end, even if someone who is a scalper is using a 5-minute chart, that price is always going to follow what is happening on the bigger time frames. So the higher you go, the bigger it becomes for your trading. And you don't determine, okay, I need to be a swing. I need to be a scalper. This we have to link up with your personality. So at first, when you start trading, you don't know what type of trader are you. Once you start trading, that's when you now know, if I try to trade on M15, I don't feel comfortable. But if I trade on H4, I feel comfortable. That's when you start to know, okay, I think I'm a swing trader. Variable spreads are just as bad for news traders. Spread may widen so much that what looks like a profitable can turn into an unprofitable within a blink of an eye. Those who have been trading news, I think you all know this one. Fixed versus variable spreads, which is better? The question of which is better option between fixed and variable spreads depends on the need of the trader. There are traders who may find fixed spreads better than using variable spread brokers. The reverse may also be true. Generally speaking, traders with small accounts and who trade less frequently will benefit from fixed spreads pricing, especially me, because I'm a long-term trader. And traders with larger accounts who trade frequently during peak hours market when the spread are the tightest will benefit from variable spreads. Traders who want fast trade execution and need to avoid records will want to trade with variable spreads. Okay, spread cost and calculation. Now that you know what a spread is, the two different types of spreads which we spoke about. Spread, we said, is the difference between bid and ask. Then two types of spreads, we have fixed spreads and variable spreads. How the spread relates to actual transaction cost. It's pretty easy to calculate, and all you need are two things. One, value per pip. Number two, the number of lots you are trading. I'm also going to teach you guys about lot sizes, but not today. Today we are focusing on spread. So when you want to calculate the transaction cost, the cost of doing business, remember, whenever you want to start a business, you need capital. That's the cost of doing business. So in Forex trading, you need to pay the spread to the broker because they've gave you the access to the market from interbank market. Okay, let's look at an example. Euro USD, the spread in pips, that's 1.4. If you subtract 1.35640 and 1.3562, you get 1.4 pips. In this quote above, you can buy Euro USD at $0.36640 and sell Euro USD at, so it's like the bid and the ask. This means if you were to buy Euro USD and then immediately close it, would result in a loss of 1.4 pips. To figure out the total cost, you would multiply the cost per pip by the number of lots you are trading. So if you are trading mini lots, 10,000 units, the value per pip is equals to $, that is 0.1 lot. Your transaction cost would be $40 to open this trade. So it means every time you try to open a trade using $0.1 on Euro USD, you are paying a transaction cost of $40. So it means whenever you open a trade, the moment you place a trade, you start in a loss of minus 1.40 cents because that money is going to the broker. So we say 1.4 spread in pips, 1 mini lot, that's 10,000 units, that is 0.0, sorry, that is 0.1. So you get $1 per pip. So you get this, your spread, that's why it's $40. The pip cost is exponential. This means that you need to multiply the cost per pip by the number of lots you are trading. If you increase your position size, that is increasing your lot size, your transaction cost, which is reflected in the spread, will rise as well. For example, if the spread is 1.4 pips and you are trading 5 mini lots, then your transaction cost is $7. 5 mini lots, that's 0.5. So you are paying $5, it's like $5 per pip. So $5 times $40, you get $7. That's the example right there. Okay. For today, guys, let's end it here. Tomorrow, we are going to focus on 6 crucial things to consider when choosing a Forex broker. So for today, let's end our lesson here. So please share the link with your friends, because I know there are plenty of guys who needs to know the basic part of Forex. Those who are still new, share the website with them, share our link, our YouTube channel, and subscribe so that you also get benefits, because remember we're going to be sharing analysis every week. Last week we shared Euro GBP and it followed what I said. So it means something is happening. And I'll also continue giving the free analysis so that you guys, whilst you are trading, you know we are not just talking. We are talking something that we have experience on. We are saying something that we know. So please subscribe to our YouTube channel, Billion Milestone Forex Group. so that you get benefits from this thing. So for today, let's end it here. But for tomorrow, we start our next lecture is 6 crucial things to consider when choosing a broker. I'll be explaining from my own experience and everything so that you have better understanding. Thank you so much, guys. Thank you for tuning in. Thank you so much.